All right, let's move on. Volatility-based charts. For example, 16-pip range bars. A new bar or candle is plotted if the market moves a specified amount. In this case, 16 pips. It's used by maybe 5% of traders, maybe less. Okay, and I think they're awesome. Here's why. So what is a range bar? A range bar has fixed length. For example, 16 pips, that's something that I like to use in the euro currency. And the next bar only forms when the market moves 17 pips from the high or the low. So it doesn't really matter how long it took or how many trades it took, as long as the market moves. So we're taking volume information out of the market and time out of the market. We're just looking at volatility. And guys, seriously, isn't that what we do as traders? Isn't that exactly what we look for? Volatility? Do we really want to trade time? Do we want to trade volume? Or do we want to trade movement in the market? Volatility. That's what we trade. So why don't we look at it this way? Get the idea, huh? Okay, so what are the advantages of range bars here? Well, first of all, you know where the high of the bar will be, because the high of the bar will be exactly 16 pips away from the low of the bar. It can't be any other way. This is by definition. And therefore, you also know where the low of the bar will be, because it will be exactly 16 pips away from the high of the bar. Can't be any other way. You know where the bar will close, because by definition, as you can see here in this example, the bar will either close at the high or it will close at the low. There's no other way around. Can't be any other way. And you know where the next bar will open. So if the previous bar closed at the high, the next bar will open, as you can see on the second bar, one pip above the high. If the second bar, the bar closes at the low, the next bar will open one pip below the low of the bar. Now just think about it. When you plot a bar or a candle, I know that some of you are candlestick fans, and that's fine. What are the 4 variables that you have when plotting a bar or candle? It is the open, the high, the low, and the close, right? Take a look at this chart. You know where the high will be, you know where the low will be, you know where the bar will close, and you know where the next bar will open. Isn't that cool? But I think the most significant advantage of range bar is that it eliminates noise. Take a look at the chart in the upper left. This is a typical 15-minute chart of the euro currency, and you recognize. On the left-hand side, there's some time during low activity where there's nothing going on. Overnight session, for example. Then, suddenly, the market moves. And you see this one long bar there? I don't know. Can I use a pointer here? I don't know if you can see this. Doesn't really matter. You get the point. You have this one long bar, bang! And then the market is going sideways again. And towards the end of the day, it is, again, shooting up. So what is the problem that many traders have when looking at such a bar and using technical indicators? When you have the long bar, by the time your indicators are screaming buy, the move is already over and the market is going sideways. Now take a look at the 16-tick range bar in the lower right-hand corner here. Here you see that the times while the market is flat and not moving is condensed. And then you see instead of having this one long bar, you can see the pointer? Okay. So here during this move, you see it's not one long erratic bar, it's like 10 bars. There's even a retracement in there. So you see plenty of time to enter into the move, also towards the end of the day. And during times when there's nothing going on, okay, it's again collapsed. So this is the long move, and instead of having a whole bunch of nothing there, we only have a few bars of nothing, and then it points up again. Isn't that nice? Really love this. So, how can you take advantage of range bars? How do you trade range bars? Well, you probably have to click on this. This here is my famous ping pong strategy. That's it. It's one slide. Everything is on there. So, yeah. What I do is I look at the first bar and I bracket the bar. I want to buy one tick below the low, and sell one tick above the high, wherever the market goes first. Buy at the low, sell at the high, buy at the low, sell at the high. And you see how beautiful this works in a sideways market. And this is a strategy for a sideways market. But it doesn't work in a trending market, obviously. This is why I said it is so important that you learn how to identify the direction of the market. You first, like a doctor, have to diagnose the patient. See, okay, what is the market doing right now? This morning, for example, I've been trading the E-mini S&P this morning. E-mini S&P, because again, for me, it doesn't matter what market I trade. I use range bars, and then the instruments now don't matter anymore. So this morning, this market has been going sideways. So what do? Apply the ping pong strategy. For how long? Until it starts trending. Then I use my favorite trend following strategy. Get the idea? I know, all really abbreviated here, but I just have 20 minutes, and I'm already at 22 minutes right now. So I need to wrap it up here right now. Okay? So, guys, seriously, I know that there are a bunch of questions coming in. We'll see what we can do here to help you. So, do you think, would it help you if I showed you how to trade this strategy live while the markets are moving? If you would switch to the markets right now and watch the markets for the next 2 hours, and I show you how to trade the strategy, how to identify the direction of the market, then also would it help you if I, in addition to this, gave you another strategy for a trending market? Would it help you if we take now 2 hours and I explain to you what I see on the charts, when to trade, how much to risk on a trade, how to manage the trade? I do believe that this might help you. I see we're running a little bit out of time, but this is what we put together here.